Welcome to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Samsara, trading under the ticker IOT. Samsara is executing a deliberate, highly profitable corporate turnaround that prioritizes enterprise platform scale over fragmented legacy telematics, intentionally transitioning its product mix toward AI-powered safety and workflow automation. However, this strategic pivot creates a structural tension, temporarily absorbing infrastructure investment costs while establishing an elite, multi-year, recurring revenue compounding engine.
Yeah, and that structural tension is really the core of what makes this whole situation so fascinating.
It really is. So I want you to just imagine like a 10-ton cement truck, right? Just barreling down the highway.
Right, with the mud on the tires and the diesel fumes in the air.
Exactly. Now, I want you to imagine that exact same truck generating more real-time data, like per minute, than a Silicon Valley software engineer's laptop.
Which sounds completely wild, right? But that is exactly what we're unpacking today.
Yeah, because I think, you might traditionally think of the technology sector as strictly software on a screen, right?
Sure, like code living in the cloud, mostly serving knowledge workers in these, pristine air-conditioned offices.
Right, but Samsara is taking Silicon Valley and essentially dragging it into the dirt, into the grit and the diesel of the actual physical economy.
They really are. They are turning basically the dirtiest, most analog industries on Earth into these giant rolling computers.
Which is wild. So our mission in this deep dive is to figure out exactly how they are achieving this massive 30% revenue growth at a nearly $2 billion scale.
Right, while simultaneously achieving pure GAAP profitability.
Yeah, and we really need to look at what their multi-billion-dollar backlog tells us about the future of physical industries overall.
And I think it is a critical mission because we first have to establish the sheer stakes of the end markets we are talking about here.
Yeah, the scale is just massive.
It is. If we look at global GDP, physical operations represent over 40% of the entire global economy.
Wow, 40%.
Yeah, 40%. We are talking about the foundational pillars that basically keep modern society from collapsing.
Right, to transportation, wholesale, and retail trade, heavy construction.
Exactly. Plus field services, logistics, utilities, all of it. Yet, despite being 40% of the economy, historically, these sectors have been completely starved of digital innovation.
Like running on paper and clipboards.
Literally paper checklists on clipboards, highly reactive maintenance schedules, and just these fragmented, clunky point solutions.
So what does Samsara actually do differently here?
Well, what Samsara has introduced to this space is the concept of the connected operations cloud.
Right.
And it is crucial to understand that Samsara is not just some hardware manufacturer, slapping GPS tags on delivery vans.
Yeah, and they aren't just a software dashboard company either.
No, exactly. They are positioning themselves as the actual digital nervous system for the physical economy.
The digital nervous system, I like that.
Yeah, they are connecting everything from, towering 10-ton construction cranes to municipal snowplows into this single, unified, intelligent data architecture.
Okay, let's unpack this. Because, it is one thing to write elegant software that lives in a pristine data center, right?
Oh, absolutely.
And it is entirely another thing to deploy it in a harsh, chaotic physical environment.
It's a completely different game.
Right. So I'm trying to picture this. How does a company actually bridge the gap between complex AI code running on, say, an Amazon Web Services server and a cement truck rolling through a dusty, vibrating construction site in the middle of nowhere?
Well, that is the fundamental engineering hurdle, right? And the bridge is forged through ruggedized hardware that acts purely as a conduit combined with just a staggering volume of data.
So the hardware has to be tough.
Extremely tough. The physical hardware, the dash cams, the asset gateways, the sensors, they all have to be built to withstand extreme temperatures, moisture, and incredibly violent vibrations.
But the hardware isn't actually the product, is it?
No, not at all. The hardware is just the sensory organ. To truly understand why Samsara is growing at this explosive rate, we have to pull back.
Okay, pull back to where?
We have to look at the massive macroeconomic environment that is essentially forcing their customers to adopt this technology.
Right, because nobody in heavy construction buys enterprise software just for fun. They do it because they literally have to.
Precisely. Samsara's customers are incredibly asset-heavy, and they are incredibly labor-intensive.
Right, lots of trucks, lots of workers.
Exactly. For the operators running these critical physical industries, operating costs typically eat up roughly 80% of their top-line revenue.
Wow, 80%. That leaves practically no room for error.
Exactly. They operate on razor-thin margins where inefficiency isn't just an annoyance, it is ruthlessly punished by the market.
Yeah, you just bleed cash.
Right. And these companies are the builders and maintainers of global infrastructure, and right now they are staring down a macro setup that is completely unprecedented in human history.
Which brings us directly to the numbers. And if you are listening to this and wondering why on earth physical operations, garbage trucks and snowplows, are suddenly a hotbed for cutting-edge enterprise technology.
It sounds counterintuitive at first.
It does. But we have this staggering data point from McKinsey and Company in our sources.
Oh, the $106 trillion number.
Yes. McKinsey projects that the global need for new and improved infrastructure will require roughly $106 trillion in investment by the year 2040.
$106 trillion, it's almost hard to comprehend.
It is. And these industries simply cannot just hire more people to meet a demand wave of that magnitude. It's mathematically impossible.
Right.
They have to become structurally more efficient.
Yeah, you absolutely cannot brute force your way through a $100 trillion infrastructure supercycle using paper, spreadsheets, and whiteboards.
It just won't work.
It won't. And the sources outline 4 structural macroeconomic pillars of demand that are actively accelerating this scale for Samsara's customers.
Okay, let's go through those. What's the first one?
First, and perhaps most prominently right now, you have the explosive build-out of AI data centers.
Right, the AI boom.
Yeah, we tend to talk about AI in the abstract, right? Like, it's just algorithms and chat interfaces.
Yeah, magic software in the sky.
Exactly. But training these large language models requires immense, heavy physical infrastructure.
You physically have to build the data center.
Yes. We are talking about millions of tons of concrete, specialized steel structures, massive industrial HVAC cooling systems.
And someone has to actually deliver all of that.
Right. The complex logistics networks required to deliver all of those materials to a site. That is Samsara's core customer base right there in action.
I love that point. We talk about the cloud like it's this magical, ethereal thing floating above us.
But it's really not.
No, the cloud still lives in a giant windowless building somewhere on Earth.
Oh.
It requires actual dirt to be moved and steel to be poured.
Exactly. The digital world is entirely dependent on the physical world, and that leads directly to the second pillar of demand.
Which is power, right?
Yes. Supporting that massive AI and data center build-out requires a complete overhaul of power generation.
Because these AI chips run incredibly hot and use a ton of electricity.
Right. We need new power plants, advanced cooling infrastructure, and entirely modernized electrical grids and transmission capacity to handle the load.
And again, you need physical trucks and people to build that grid.
Exactly. Thousands of utility trucks, cranes, and specialized field service crews.
Okay, so that's data centers and power. What's the third pillar?
Third, you have aggressive government investment in the modernization of aging public infrastructure.
Like roads and bridges.
Right. Think of the state and local public works agencies that are tasked with rebuilding decaying roads, bridges, and municipal water systems.
Yeah, there's a lot of government money flowing into that right now.
A ton of it. And finally, the fourth pillar is private enterprise digital transformation.
What does that look like on the ground?
Well, private operators are completely re-engineering their physical supply chains from the ground up. They have to, just to meet the real-time, next-day delivery demands of modern consumers.
Right, the Amazon effect.
Yeah.
Everybody wants everything tomorrow.
Exactly.
So let's put ourselves in the shoes of one of these operators for a second.
Okay.
You are facing this absolute tidal wave of demand from AI data centers needing steel to the government paying to rebuild highways.
Demand is everywhere.
Right. But you have a massive problem. You are severely constrained by worker capacity. You literally do not have the humans to do the work.
Yes, the worker shortage.
So you have to turn to Samsara's emerging AI products to automate your workflows. And this worker capacity crisis, it's not just a minor headache or a seasonal hiring slump, is it?
No, it is a severe structural bottleneck for the entire global economy.
How bad are we talking?
Well, the data we are looking at highlights a critical insight from Samsara's CEO, Sanjeet Biswas.
Okay.
He noted that frontline worker turnover in these industries is currently sitting at 40 to 50%.
Wait, 40 to 50% turnover every year.
Every single year. I really want you to let that sink in. Half of your entire workforce is quitting or turning over every year.
That is just brutal for a business.
It's devastating. And as Bezos points out, in these asset-heavy businesses, the number of frontline workers required scales directly in tandem with revenue.
Right, because if you want to deliver more goods, you need more trucks.
And if you have more trucks, you need more drivers. So if you lose half your people annually, that is a direct mathematical drag on your capacity to grow.
And it's not like you can just pull someone off the street and put them in a 10-ton crane the next day, right?
Exactly. Many of these roles require highly specialized, licensed, and trained workers.
Like commercial CDL drivers.
Right. CDL drivers, master electricians, heavy equipment operators, construction specialists. And these workers are increasingly retiring and generally in short supply.
The younger generation isn't really jumping into those trades at the same rate.
No, they are not entering these trades at the rate required to replace the retirees. This isn't just a cyclical dip in the labor pool where you can just ride it out.
So it's permanent.
Yeah, it is a permanent structural deficit holding back growth.
So if you can't hire more humans, you have to make the humans you do have superhuman.
That's a great way to put it.
And the solution Samsara is offering to bridge this gap is what they call operational AI.
Yes, operational AI.
And to give you a sense of the scale here, in fiscal year 2026, Samsara's data platform processed over 25 trillion data points.
25 trillion, that number is just huge.
It's insane. We are talking about real-time video footage from dash cams, granular GPS location pings, engine diagnostic data, energy consumption metrics, and even AI-driven people and motion detection.
Yeah, the ingestion is massive.
It's essentially like turning every single vehicle, every piece of heavy machinery, and every hard hat into a real-time data node feeding back into the cloud.
What's fascinating here is that 25 trillion data point figure isn't just a vanity metric, you know?
Oh, it's not just for show.
No, it is the absolute foundation of their entire competitive moat.
Because of how machine learning works.
Exactly. Machine learning models are only as good as the data they are trained on. The more data Samsara ingests from the real world, the smarter their AI models become.
Right, it's a compounding effect.
It is. A smarter model allows them to automate increasingly complex physical workflows. And we are seeing the direct financial proof of this compounding intelligence in their emerging product segment.
Right, so let's dig into that. Let's do a forensic audit of these emerging products because this is where the growth story really accelerates.
It really is the growth engine right now.
Yeah, these emerging products contributed over 20% of net new annual contract value, or ACV, for the second consecutive quarter.
And just for our listeners, when we say net new ACV, we are basically talking about the brand new recurring revenue dollars walking through the door.
Right, fresh cash. And 7 of Samsara's top 10 net new ACV transactions included one of these emerging products.
That's a huge attachment rate.
It is. And 32 transactions in Q1 alone included over $100,000 purely in emerging product revenue.
Just for the emerging products.
Yes. These are products completely outside their traditional legacy telematics and basic video safety core.
And the absolute standout in this category is their connected asset maintenance vertical.
Oh yeah, the Hertz deal.
Right. In Q1, Samsara signed their largest ever connected asset maintenance deal with Hertz, which is obviously one of the world's largest car rental and mobility solutions providers.
Massive fleet.
Massive. But what makes this deal so critical to understand is the deployment mechanism.
Okay, how do they deploy it?
It was a software-only deployment across their entire North American vehicle fleet.
Wait, hold on. You're telling me Hertz bought this entirely for software? No hardware?
Yep, zero hardware.
I'm confused. Isn't Samsara's whole pitch that they put rugged boxes in trucks? How does a software-only deal even work for them? I thought they were a hardware-as-a-conduit company.
Well, it's a massive paradigm shift, and it completely validates their platform approach.
How so?
You see, historically, Samsara had to physically mail a ruggedized IoT gateway to a customer, right? And then a mechanic had to physically plug it into the vehicle's diagnostic port.
Yeah, which takes time and money.
Exactly. But modern vehicles, especially the newer models making up Hertz's consumer fleet, they're essentially rolling computers already.
Right, they have sensors everywhere.
Yes. They already have the sensors. They already have the cellular modems built in at the factory by the original equipment manufacturer, or OEM, brands like Ford or GM.
Ah, so the physical hardware is already sitting in the rental car on the lot.
Exactly. So Samsara doesn't need to send a physical box. They just use cloud-to-cloud APIs.
Just software talking to software.
Right. They securely ingest the data directly from the vehicle's existing factory-installed nervous system straight into the Samsara Connected Operations Cloud.
That is wild.
It's a pure software integration. This means zero installation time, zero hardware costs for Samsara, and instant deployment across tens of thousands of vehicles.
That is incredible. It's like downloading an app instead of buying a whole new smartphone.
It really is.
But what is Hertz actually doing with this data? I mean, why pay for Samsara's software if they already have the data in the car?
Because they are completely revolutionizing their maintenance logistics. Samsara's connected asset maintenance helps customers shift from reactive, time-based, or mileage-based maintenance schedules.
Like bringing a car in every 5,000 miles, whether it needs it or not.
Exactly, which is super inefficient. They shift from that to a proactive, highly predictive, data-driven approach.
Which saves money.
A ton of money. For a massive fleet operator, maintenance is typically one of the largest cost centers, consuming an average of 10% of their entire operational budget.
10% for a company the size of Hertz is huge.
Huge. By centralizing the service lifecycle and using real-time diagnostic data and AI-driven suggestions, Hertz can predict engine or battery failures before they actually happen.
So they swap the car out before it dies.
Right. This extends the asset's lifecycle. It avoids renting a car to a customer that just breaks down on the highway and significantly lowers emergency repair costs.
And it isn't just commercial rental fleets that are figuring this out either. We are seeing this operational AI push heavily into the public sector.
Oh, the government contracts?
Yeah. Our sources highlight the state of Connecticut as a major Q1 win. And the features they are deploying are wild things like waste intelligence and ground intelligence.
Those names sound like something from a sci-fi movie.
They really do. Let me paint a picture for you. Imagine being a public works director in Connecticut, right?
Okay.
You're getting yelled at by taxpayers about potholes everywhere. And because of that worker shortage we talked about,
Yeah.
you have half the staff you had 5 years ago.
A nightmare scenario.
Total nightmare.
Yeah.
Sending a guy in a municipal truck to just drive around all day looking for holes in the road is a terrible, inefficient use of time.
It's just burning gas and payroll.
Exactly.
Yeah.
So instead, Samsara basically turns every garbage truck in the city into a pothole hunting spy.
That is so clever. And if we connect this to the bigger picture, it is a brilliant utilization of existing assets.
Right, because the truck is already driving there.
Exactly. Think about the mechanics of waste intelligence. They are putting AI cameras on municipal waste trucks.
Right.
Now, these cameras aren't just streaming 4K video of trash back to the cloud 24/7.
Oh, because that would be incredibly expensive.
Yeah. That would require an astronomical cellular data bill and massive server costs. Instead, they are utilizing edge computing.
Okay, so computing on the actual camera.
Yes, the machine learning model actually runs locally on the camera hardware itself, right there on the back of the garbage truck.
So it's analyzing the video in real time on the truck.
Exactly. It can automatically verify that a specific bin was picked up or detect if a recycling bin is contaminated with non-recyclable materials.
Like throwing a plastic bag in a cardboard-only dumpster.
Right. And then it only sends the relevant data packet or alert back to headquarters, saving massive amounts of bandwidth.
That is so smart. And then there's ground intelligence.
Right. Ground intelligence analyzes the vehicle data, and the camera feeds to actively map and detect road defects, like potholes or damaged road signs, for the public works teams.
While they are just doing their normal route.
Exactly. The garbage trucks are driving every single street in the city every week anyway. By outfitting them with this AI, the city gets a constantly updated real-time map of road conditions without requiring a single human inspector to drive a single extra mile.
It is brilliant. You're taking a dumb asset, a garbage truck, and turning it into an active intelligence gathering node.
It's total operational leverage.
And this naturally leads us into how Samsara is making so much money off of this. Because what we're really talking about is an aggressive enterprise land and expand playbook.
Exactly. This is the natural evolution of the customer journey.
How so?
Well, these emerging products almost always begin as incredibly simple, tactical, single-point deployments.
Like just buying one thing to solve one problem.
Right. A city or a massive logistics enterprise might start by just installing forward-facing dash cams to reduce insurance liabilities and prevent accidents.
Or maybe they just buy basic telematics to track where their vehicles are on a map.
Exactly. But because all of this hardware and all of this data feeds into one single unified cloud architecture, that initial simple deployment quickly evolves into a total digital transformation.
Because the customer realizes the data is already flowing. The hard part, actually getting the hardware in the truck, is already done.
Precisely. They realize they can just flip a software switch to activate connected workflows or asset tags or predictive maintenance.
Just turning on a feature in the cloud.
Yes, and the return on investment is undeniable. The sources note that Samsara believes they can help these organizations reduce certain operational costs by up to 10% within just 18 months of deployment.
10% in 18 months.
Right. And when you are a billion-dollar logistics company operating on 3% profit margins, a 10% reduction in operational costs completely transforms your balance sheet.
It changes everything. So if you can solve multiple, completely distinct operational problems like safety, maintenance, and routing with one unified platform, your ability to cross-sell goes through the roof.
Oh, absolutely.
Let's break down the Q1 FY27 numbers to see this in action, because we are seeing what we can call an enterprise inversion.
Okay, let's look at the numbers.
Samsara ended the quarter with 3,363 customers spending $100,000 or more in annual recurring revenue.
That's a massive cohort of large customers.
It is.
Yeah.
And that 100K plus cohort is growing 37% year over year, which represents the third consecutive quarter of sequential acceleration at a larger scale.
And if you look at the absolute apex of their customer pyramid, the growth is even more aggressive.
Yeah, the $1 million accounts.
Right. They now have 190 hyper-enterprise customers spending $1 million or more in ARR.
$1 million a year on software for trucks.
It's wild. That specific segment spiked 62% year over year, marking the fourth consecutive quarter of sequential acceleration.
That is just explosive growth at the top end.
It is. And in the software industry, it is notoriously difficult to sell seven-figure contracts. When your largest, most demanding, most complex customers are your fastest-growing segment, it proves that the platform is fundamentally built to handle immense scale.
It is not just a toy for small businesses.
Exactly.
Here's where it gets really interesting. The multi-product density is the actual moat protecting that growth.
Yeah, the cross-selling.
Right. 96% of the 100K plus ARR customers subscribe to 2 or more Samsara products.
96%.
Yeah. And 70% subscribe to 3 or more. This is how Samsara is systematically beating single-point solution competitors.
Right.
If you look at legacy companies like Motive or Lydex, they might offer a great dash cam or a great GPS tracker. But Samsara is uniting video safety, telematics, predictive maintenance, and connected sites under a single cloud interface.
And that multi-product density is the absolute key to enterprise retention.
Why is that?
Well, let's look at some of the major Q1 wins mentioned in the sources, like Foundation Building Materials, which is a leading North American specialty building materials distributor, or take one of the world's largest global pizza chains.
Okay, so you have the pizza chain.
Right. If you are that pizza chain and you are using Samsara for AI video safety to monitor your delivery drivers, plus asset tracking to know where your trucks are, plus connected workflows to manage your dispatch,
You are deeply embedded.
the platform becomes entirely unpluggable.
Unpluggable, I love that word. It means you are trapped, but in a good way.
It does. The switching costs become astronomically high. You aren't just ripping out a piece of software that tracks a truck on a map. You are ripping out the digital nervous system that governs the safety, maintenance, routing, and compliance of your entire physical supply chain.
The operational disruption of trying to switch to a competitor would be catastrophic.
It would just be a nightmare. And the data explicitly notes this dynamic helped Samsara achieve their target dollar-based net retention rate of approximately 115% for core customers.
So basically, even if they don't sell to anyone new, they still grow.
Exactly. This means that even before they sign a single new customer, their existing customer base is spending 15% more with them every year just by adding more products and more vehicles to the platform.
Okay, so they built this unpluggable product that customers love, and they're landing massive enterprise deals.
Right.
But building AI for garbage trucks and cement mixers is astronomically expensive.
It's not cheap.
The natural question is, are they just burning mountains of cash to achieve this 30% growth?
Yeah, that's what investors always worry about.
Exactly. Let's look under the hood at the financial plumbing of the operation. This brings us to the margin expansion audit, which is arguably the most critical part of the entire thesis.
It is the ultimate litmus test of their corporate turnaround.
Exactly. Let's look at the profitability milestone, Q1 FY27 was Samsara's third consecutive quarter of GAAP EPS profitability.
That's a huge milestone.
It is. They posted $44.5 million in GAAP net income, which equates to 8 cents per share. Now, for you listening, we need to demystify this.
Let's explain GAAP.
Right. GAAP stands for Generally Accepted Accounting Principles. It is the strictest, most conservative way to measure a company's profits, including all the messy stuff like stock-based compensation for employees.
The real hard costs.
Yeah. For a high-growth software-as-a-service company that was previously categorized by Wall Street as a relentless cash burner, achieving pure GAAP profitability is a massive structural inflection point.
It proved the business model actually works.
Exactly. It proves it's a real business.
It is a profound shift in operating leverage. Let's forensically dissect the spectacular 500 basis point expansion in their non-GAAP operating margins.
Let's do it.
In Q1 of fiscal year 2026, their operating margin was 14%. By Q1 of fiscal year 2027, it had jumped to 19%.
Let's pause and do the math on a basis point, because if you aren't staring at financial models all day, that sounds like alien math.
Fair enough.
A basis point is just 1/100th of 1%.
Right.
So when we say a 500 basis point expansion, we mean their profit margin literally jumped by a full 5%.
Yes.
In the software world, doing that while you are simultaneously growing your revenue by 30%. That is like changing your car's engine while you were driving 80 miles an hour down the highway.
It's incredibly difficult.
It's incredibly hard to grow fast and become more profitable at the same time.
It requires severe operational discipline. Let's isolate the exact mechanical variables driving that expansion.
Where did it come from?
The massive driver of this efficiency was general and administrative, or G&A, scaling. G&A efficiencies alone provided a full 500 basis points of margin improvement year over year.
So basically just managing the back office better.
Right. What this means in plain English is that they are not needing to hire armies of new accountants, HR personnel, and back office staff relative to their top-line revenue growth.
The software is scaling faster than their headcount.
Exactly. On top of that, sales and marketing and research and development each contributed an additional 100 basis points of improvement.
So they are getting more efficient everywhere.
They are selling more efficiently and building products more efficiently. When you aggregate all of that, their total operating expenses as a percentage of revenue compressed dramatically, dropping from 65% down to 57%.
Wait, hold on. Let me check the math here.
Okay.
If G&A improved by 500 basis points, and sales and marketing improved by 100, and R&D improved by 100, there's 700 basis points of total operating expense improvement.
Yes, it is.
Yet you just said the total operating margin only expanded by 500 basis points. Where did the other 200 basis points go?
This is exactly where the strategic tension of the business model reveals itself.
Ah.
The missing 200 basis points is an offsetting contraction in their cost of goods sold, or COGS.
So their gross margins went down.
Yes. Samsara's GAAP gross margin actually dipped from 77% to 75%, and their non-GAAP gross margin dipped from 79% to 76%.
Why did it drop?
Management explicitly stated on the earnings call that this drag on gross margin is entirely due to increased cloud and AI-related infrastructure investments.
Meaning it costs a lot of money to be smart.
Precisely. Processing 25 trillion data points through advanced computer vision and machine learning models requires massive, sustained computational power.
You can't run that on a laptop.
No, you can't. When a garbage truck in Connecticut uses AI to detect a pothole, that requires processing power. That processing power shows up directly in Samsara's cloud hosting bills with providers like AWS.
So as they sell more AI, their bills go up.
As they push more AI products, their raw computing costs increase.
This raises an important question. Is this COGS hit a red flag? Because generally speaking, Wall Street analysts absolutely despise gross margin compression in software companies.
Oh, they hate it.
They want software to cost virtually zero to replicate.
Right. This raises an important question, and it requires critical thinking, not just a knee-jerk reaction to a spreadsheet.
Okay, let's think critically about it.
We have to evaluate whether absorbing these massive cloud and infrastructure costs is a sign of a bloated, inefficient architecture, or if it is a necessary temporary tension required to build an insurmountable long-term AI moat.
Right. Are they wasting money or investing it?
Exactly. If Samsara is going to successfully transition from being a legacy telematics provider, just putting dots on a map, into a true operational AI platform running complex physical workflows, they absolutely have to front-load the computational infrastructure.
You have to build the factory before you can sell the cars.
Exactly. The fact that they can absorb a 200 basis point hit to their gross margin due to AI cloud costs, while still expanding their overall operating margin by 500 basis points through incredible G&A discipline, speaks to the underlying structural strength of the business model.
Okay, but if they are spending all this money on AI cloud computing today, how are they actually paying for it?
That's the cash flow question.
Right, because GAAP profitability is an accounting metric, but you can't pay Amazon Web Services with accounting metrics. You pay them with cash.
Cash is king.
This brings us to the backlog paradox, the mechanics of SaaS accounting. We have to reconcile their massive backlog against their current revenue.
Let's look at those numbers.
The sources show they have an astonishing $3.76 billion in remaining performance obligations, or RPO, compared to their $1.991 billion in current annual recurring revenue, or ARR.
This is where understanding the mechanics of enterprise software contracts is crucial. Samsara does not sell cheap month-to-month software subscriptions that a customer can cancel on a whim. Their revenue model is secured by massive ironclad enterprise contracts that typically span 3 to 5 years.
So let's use an analogy here. Think of their annual recurring revenue, their ARR, like the water currently flowing out of a faucet today.
Okay.
It's roughly $2 billion a year. But the RPO backlog, that $3.76 billion, is the massive water tower sitting on the hill behind the house.
That is a perfect way to visualize it. When Samsara signs a massive logistics company to a 5-year, $5 million deal, only the first 12 months of that contract, $1 million, hits the current ARR baseline.
Right, the water flowing from the faucet right now.
Exactly. The remaining 4 years of committed, legally binding value, the other $4 million, is funneled directly into the RPO backlog, the water tower.
So it's guaranteed money that just hasn't flowed down yet.
Yes. So that $3.76 billion represents highly visible, contracted future revenue that simply hasn't been recognized by the accountants yet.
It's basically money in the bank.
Pretty much. Even if Samsara didn't sign a single new customer tomorrow, that water tower guarantees the faucet will keep running for years.
And there's another hidden layer to this financial plumbing. The deferred revenue cushion.
Right, because of how they collect the money.
Yeah, because many of these large commercial and public sector accounts actually choose to pay for their annual software subscriptions up front in cash before the year even starts.
Yes, and that dynamic floods Samsara's balance sheet with highly liquid cash.
Which is amazing for them.
It is.
Yeah.
From an accounting perspective, they haven't earned that revenue yet because they still owe the customer 12 months of software service.
So where does it go on the balance sheet?
So this cash sits on the balance sheet as a liability called deferred revenue, and it is recognized slowly month by month as the service is delivered.
But practically speaking.
But from a purely operational standpoint, Samsara has the cash in hand today. It acts as an incredible financial buffer and a massive source of working capital.
And that upfront cash collection is exactly what drives their elite free cash flow conversion.
Let's hear the cash flow numbers.
In Q1, Samsara generated an adjusted free cash flow of $73.2 million, which yields a 15% adjusted free cash flow margin.
That is massive.
It is. That is a massive 300 basis point improvement from the 12% margin they generated in the same quarter last year.
So they are getting better at generating cash too.
Yes. So to summarize the financial firepower here, they have $700 million in pure balance sheet liquidity. They are printing 15% adjusted free cash flow margins, and they are dedicating roughly 20% of their top-line revenue right back into research and development.
And that is the ultimate competitive advantage. This elite cash conversion allows Samsara to act as an aggressive growth compounder.
What do you mean by growth compounder?
They can structurally out-innovate their legacy telematics competitors who are operating on razor-thin hardware margins and simply don't have the free cash flow profile to keep up with the massive AI capital expenditure cycle.
Right, because if you are barely surviving, you can't build AI.
Exactly. If you are a legacy competitor trying to build an AI computer vision model to compete with Samsara, but you are barely breaking even, you simply cannot afford the AWS cloud bills required to train the model.
It's not just a software game anymore. It's a financial trench war.
It really is.
And that cash hoard also gives them the resources to aggressively defend their territory.
Oh, like the litigation.
Yeah. A prime example highlighted in the sources is the $30 million arbitration award Samsara won against one of their primary competitors, Motive, in February of 2026.
That was a huge deal in the industry.
It wasn't just a minor squabble either. This was a major dispute involving allegations of breach of contract, fraud, unfair competition, and false advertising.
Right. It proves that having the financial power to litigate and fiercely protect their proprietary platform and their intellectual property is a critical component of maintaining their competitive moat.
They can afford the best lawyers.
They aren't just out-engineering the competition. They are out-resourcing them and aggressively policing the market.
So, synthesizing all of these massive data points, the 106 trillion macroeconomic tailwind demanding infrastructure efficiency, the worker capacity crisis forcing automation, the enterprise multi-product density making them unpluggable, the 500 basis point operating margin expansion, and the multi-billion-dollar RPO water tower.
That is a lot of tailwinds.
It is. So what is the final investment case for Samsara? And critically, what are the execution risks that could derail this entire story?
Right, because nothing is guaranteed.
Exactly. So what does this all mean? Let's apply our summary analogy here.
Well, the final synthesis is that Samsara is successfully positioning itself as the unassailable, mission-critical digital nervous system for the physical economy.
The digital nervous system again.
Yes. They are evolving into a cycle-resistant software powerhouse because, frankly, you simply cannot run a modern, efficient global supply chain without this granular real-time data.
You just can't compete.
You can't. You can't manage a 10,000-vehicle fleet on a whiteboard anymore. Their ability to expand their operating leverage while simultaneously absorbing the costs of pushing heavily into new AI verticals proves the elasticity and the resilience of their business model.
But no company is invincible. What are the primary execution risks evident in the data? Where could this go wrong?
The first is the strategic margin tension we discussed earlier.
The cloud costs.
Right. The primary internal execution risk is the potential for further margin compression if those AI infrastructure investments, which already cost them 200 basis points in COGS, begin to outpace their top-line revenue growth.
Because processing AI is just so expensive.
It is. They must ensure that the new operational AI products, like Waste Intelligence, command enough premium pricing to eventually offset the massive cloud computing costs required to run them.
So they have to charge enough to cover the server bills.
Exactly. If the cloud bills grow faster than the subscription revenue, the profitability narrative falls apart entirely.
That makes sense. And what about external risks?
Externally, their entire growth narrative is tethered to the assumption that the 106 trillion macro infrastructure spend continues without severe recessionary delays.
Right. What if the economy just tanks?
If governments suddenly pause infrastructure modernization due to budget deficits, or if the AI data center build-out slows due to capital constraints, Samsara's customers will feel that pinch directly.
And if they feel it, Samsara feels it.
Yes. If construction companies stop buying new cranes, they stop buying new Samsara software licenses. That could severely slow their enterprise expansion rates.
And we also have to consider the hardware side. Even with software-only deals like Hertz, the physical sensors have to actually exist somewhere.
Exactly. The competitive landscape is not static.
Who else is coming for them?
They face intense competitive pressure, not just from point solutions like Motive, but from massive legacy telecommunications companies and the automotive giants themselves, the OEMs like Ford, GM, and Volvo.
Right, because Ford is building this stuff into the trucks now.
Yes. These manufacturers are increasingly trying to factory fit their own connected hardware and proprietary software dashboards directly into vehicles and heavy machinery before it even reaches the customer.
So they might not need Samsara.
That's the risk.
Yeah.
Samsara has to constantly prove that their hardware-agnostic unified cloud is superior to whatever the manufacturer builds into the dashboard.
Yet, despite those very real risks, management's forward outlook signals immense confidence.
They are very confident right now.
Yeah. On the heels of this data, they officially raised their full-year FY 2027 revenue guidance to a range of $2.005 billion to $2.013 billion.
Raising guidance is always a strong signal.
It is. That effectively passes through their Q1 outperformance and tacks an additional operational runway, all while projecting to remain perfectly GAAP profitable for the entire fiscal year.
It is a statement of extreme confidence in the predictability of that multi-year backlog and the stickiness of those 100K and million-dollar enterprise customer cohorts.
They know the money is there.
They know the water's in the tower, and they know the customers aren't unplugging the system.
Which leaves us with a final provocative thought for you to mull over as we wrap up this deep dive.
It's an interesting philosophical point.
It really is. We spend so much time talking about AI as a novelty, right?
Yeah.
Like a chatbot writing emails or generating funny images on a screen.
Yeah, parlor tricks, basically.
But as artificial intelligence transitions from generating text in an office to directly controlling, routing, and optimizing 10-ton physical assets out in the real world, does the true value of AI ultimately belong to the tech companies in Silicon Valley with the most elegant algorithms? Or does it belong to the companies like Samsara, who actually own the proprietary, chaotic, real-world data feeds that are required to power them?
That is the million-dollar question.
Risk defined, portfolio protected.